It's a brand new year and it's time to give a brand new look to your mutual fund portfolio. And the first step is to get back to the basics. Our expert Dhirendra Kumar, CEO of Value Research, joins us live and exclusive as always with his thoughts on the MF Corner. Afternoon, Dhirendra. Wish you a very, very happy new year to start things off. Firstly, tell us, what can we expect?
Wish you the same.
Yes, I was asking Dhirendra, what can we expect from the mutual fund space in the year 2030?
One clear expectation is that rate cuts will materialize, and that will bring income funds on the forefront. And even if equities struggle, it should they will keep the interest alive, and so they will become very attractive. So that is something which I expect with a reasonable confidence. That apart, I visualize that what has happened to the behavior of a mutual fund investor has been extremely disappointing. They have been disappointed and they have been exiting. We have seen the record the highest outflow from equity funds in 2012 despite a reasonable year on performance front. So I see a reversal on that front as well. And I see that the multi caps and the mid and small cap, what we have seen over the past 3-4 months, should prevail, because if there is a possibility that the markets may not, it's so narrowly propelled by FII flows, but I feel that selectivity will still dominate, and multi-caps, mid-cap funds will continue to perform just as well, or reasonably well, if not as well as we have seen in the past 3-4 months.
Dhirendra, hi, afternoon. So what kind of an asset mix would you suggest for short-term as well as long-term investors?
No, I don't think this outlook actually changes anything dramatically. One should be guided by one goal. So all the money which you need in the next 6 months, 1 year, 2 years of a non-negotiable kind should be into fixed income. The other thing which is likely is that very on the short end of the fixed income, the liquid funds and the short-term bond funds, the kind of return they have been giving, that will moderate. Past 3 years we have seen a nearly 8% return, which will come down as a result of rate going down. So one should be guided by one's goal, and one should diversify, and one should be into equity for your long-term goals.
Dhirendra, it's the first day of the year, so we've got to take on some viewer queries as well. And the first one is from Sai Kiran. He wants to know if he should invest in a bank deposit or an ELSS, and needs your advice on this. What would you suggest, bank deposit or an ELSS?
If you are a completely risk-averse investor and you are likely to, you just can't take even an interim decline in value for your period of holding, and you are fine with a modest return, then go for a bank deposit. Otherwise, one should be willing, because bank deposit, their term is 5 years, and it is a illiquid thing. You can't really borrow against that bank deposit, which is a tax-saving deposit. Compared to that, I think if you have little appetite for risk, you must go for ELSS. Possibly this is the last year when you can go for ELSS. The lock-in period is 3 years, and I don't think it is a bad time. In this time period, the worst case scenario which I have seen on a 3-year holding period is that you lose 5%, but most investors on most occasions over the past 20 years, ever since ELSS have existed, they have made at least 1.5 times more than the prevailing fixed income return, which was always available by way of NSC or something like that, the tax saving avenues.